Thank you so much for joining us for our third quarter market review and outlook. We'll spend a few minutes sort of looking backwards at what has happened in markets over the last couple of months. And then we'll do some work looking forward at both the business cycle, so what's happening in the economy, as well as markets, so particularly stocks and bonds and where we see opportunities. If you have any questions, we love questions. That's what makes it fun for us. You can look on the bottom of your screen and there is a button for Q&A. So click that anytime during the presentation. Feel free to type in a question and we'll have plenty of time towards the end to be able to answer those. So for the look back portion of this, if you look at various asset class returns in the third quarter, it didn't look so good in the third quarter. You'll see that stocks both in the US and outside the US were down for that period of time. Bonds were also down. The one sort of semi-bright spot was in the high yield space, which is sort of interesting. US real estate also down in a fairly pronounced way. Really, the only kind of consistent bright spot was in commodities. Now, what's interesting is that the relative performance of these different asset classes is essentially the reverse of what we saw in the first half of the year, where stocks and bonds were generally speaking both up, commodities were down. And then, of course, 2022 looked very similar to Q3, where you had pretty much every asset class down except for commodities. So I highlight this as just an example of where sort of the relative leadership in various asset classes can change very quickly and in a very pronounced way. 2022 for many investors was a really hard period. But then sure enough, stocks rebounded really dramatically earlier this year. And in fact, if you look at year-to-date returns for the stock market, they still look very, very positive. But commodities have been a really big surprise. And much of this strength in commodities was before geopolitical risk in the Middle East really kicked up. So it'll be interesting to watch going forward. Digging into the story a little bit more, we can look at sector performance. And here too, the relative sector performance has been quite different depending on where you are. All the way over on the left, you'll see energy had by far the best returns in the third quarter. This is consistent with that strong performance that we saw in the previous slide in terms of commodities. Sort of underlying a lot of that is strength in oil markets in general. And then if you look towards the right, you'll see information technology had a really tough year in 2022, but very, very strong in the first half of this year, and then has been among one of the worst performers in the third quarter. Now, again, year-to-date performance for this sector remains very, very strong, but momentum lately has turned negative. And what I find particularly interesting about these various sector returns are looking at real estate and utilities and consumer staples as well. So often those sectors are where investors will go during times of trouble. So if you're worried about, say, economic growth slowing down, you might buy a consumer staples stock because those are the types of purchases that consumers have to make, right? Those are things like diapers and toilet paper. And so they tend to be more resilient during an economic downturn. But this is not what we're seeing here. These sectors actually underperformed even more. And then utilities and real estate tend to be areas where you have reliable dividend income that, again, is a source of, calm within an economic storm. But with interest rates going up so much, bond yields are up a lot. And so investors are saying, okay, do I want that yield on a utility company, or do I just want to buy some bonds or invest in a money market fund? Because there's some pretty attractive rates there. And so a lot of investors are saying, I'd rather go there than in utilities. Now, again, many of these sectors still have very strong performance so far this year, but it's been a very different decision-making process for the third quarter. So with that, let's take a look at the where we are in the business cycle. We put together this what we call an economic dashboard to try and give a one-stop shop about where we think the economy is. And I grew up in this business decades ago with this idea that the Fed really leads a lot of the cycle. So we look a lot at monetary policy. What is the Fed doing? In 2022, the story was very much about the fastest, sharpest Fed rate tightening cycle, arguably, that we have ever had, right? So the Fed went from essentially zero interest rates, much, much higher by the end of 2022, and now above 5% today. So the Fed had to sort of put a lot of tightening into a really short period of time. Now, of course, that's what drove bonds down. That's what really hit the equity markets. The good news now is that that gauge is sort of coming out of the red. We're either at or close to the end of the Fed rate tightening cycle. Now, they still have plenty of bonds that they own that they need to start to unload, but we're getting closer to a more neutral position. The next area that we look at is often manufacturing, and we'll take a closer look at this in a moment. But manufacturing took a lot of the hit really early on, and there's some evidence that activity is bottoming. The consumer, on the other hand, has been remarkably strong throughout this period. And we'll look at some more detailed data there. But, despite kind of the weakness that we saw in equity markets, consumers were telling us that they felt pretty good and they were spending pretty solid levels. Housing has been a little bit more of a roller coaster ride with the tremendous increase in interest rates. I would argue it's been a lot more resilient than what you would expect given the interest rates. But there, again, we're close to neutral. And then the labor market, similar to the consumer, has been very, very strong. We saw really strong wage gains, plentiful jobs. And while the labor market has cooled a little bit, it still remains very much in the green and is still quite robust. So let's dig into each of those areas in a little bit more detail. Overall, if you think about inflation, this has been the Fed's big fight for quite a long time period now. And that dark line is overall consumer price index. And if you've been following sort of economic news, over the last year and a half, you've probably seen many different ways of trying to slice and dice inflation. And economists got very creative during this period in trying to measure different ways that inflation was filtering through the system. This here is a back to basics. This is the most, commonly cited measure of inflation. And it's a basket of what are consumers paying when they go to the grocery store, when they go to the department store. How do we add all those up to sort of reflect what the average American is experiencing? So that dark line is the consumer price index. That's everything thrown into a single basket. And you'll see there, in 2022, we got almost to 10% price increases, which we have not seen in, over 100 years. So that was a really, really high increase in prices. Now, when we pull apart that basket a little bit, we start to see different experiences. So that light blue line are goods. So those are things that you can find on a shelf or in a parking lot. It's a thing that gets manufactured and created, and then you go and you take home. You can see where those goods prices move around much more. So they're much more tied to, actually, Ryan, if we could go back for a moment. So those goods prices are much more tied to input prices, things like commodities, which will drive those prices up and down. And by that measure, goods prices are down quite significantly. So the Fed has set a target of 2%, and goods price increases are below that 2%. Now, the tricky part is that services, so that dotted gold line. And there you can see running over 5% right now. So that's well above the Fed goal of 2%. And you can see typically services price inflation does not move around that much. That's things like getting your nails done, getting your hair done, getting your taxes done. There's a person associated with that service. And so that tends to be very tied to wages. So highlighting some of the reasons why this has been difficult to bring down. So let's dig into the manufacturing side a little bit more. the manufacturing is one area that saw weakness very early on during this cycle. So that's that blue line. And we have a really long history for this particular index. But you can see where that peaked actually in late 2020 and then has been steadily declining since then. Any number below 50 on this metric suggests that manufacturing overall is declining. So we have been in decline for about a year. And that first turned to negative territory like late 2022. So what we saw is essentially manufacturing was in recession earlier this year. If we look at that gold line, which is services, you can see where it peaked in 2021 and has been in steady decline, but has remained above that 50. So still growing, just at a slower pace. What we're seeing now in that manufacturing piece is that it's starting to bottom, right? So you're starting to see it kind of bump along this level and maybe start to pick up again. So an area that felt the pain early on and is starting to get back likely into positive territory. And then services are a similar trajectory without that same downside. So then let's take a look at housing, because this has been very interesting. If you look at just the mortgage rates, you can see there we're at the highest mortgage rate. Now, this is, the average 30-year fixed rate, the highest rate that we have seen since 2000. So that's, more than 2 decades of history where we just haven't experienced mortgage rates that high. What's interesting, though, even though mortgage rates are really high, we haven't seen that sort of affect the housing market in nearly as negative a way as you might expect. The reason is because most Americans who own homes have a mortgage that was set in those glory days when mortgage rates were really low. So something like 80% of all homeowners who have a mortgage have an interest rate that's 4% or below. So now that mortgage rates are above 7, those homeowners, they don't really care because they have a fixed rate mortgage and they don't have to worry about it. So what we're seeing is that people are more reluctant to sell their homes if they have a low mortgage rate. That's affected supply, so there are fewer homes for sale. But in general, those people are very inoculated against higher interest rates. Now, one area where people are not inoculated from higher interest rates is in credit card debt. So if we look on the left here, you can see household debt balance of credit cards has gotten above $1 trillion. So we are well above pre-pandemic levels. So that's telling us that consumers are continuing to spend, number one, and they're using their credit cards to help fuel that spend. Now, if we look at that relative to, say, how much income people are bringing in or relative to the size of the economy, we're not at high levels. We're at fairly reasonable levels. But where it's starting to pinch is on the right, where the interest rate that folks have to pay on that credit card debt has increased substantially. So we are well above levels that we've seen over the last couple of decades. So for those individuals, let's say, who maybe don't own a home and are not kind of inoculated through their mortgage and who have used their credit cards, they're very much starting to feel the pinch of higher interest rates. And we've started to see delinquencies tick up here. We've also seen this in autos. I was just looking at some numbers. So for instance, lower quality borrowers for cars are seeing some of the highest delinquency rates that we've seen in many years. So there are little areas where these high interest rates are starting to kind of peek through. So then if we take a look on the at the labor market, here's another area that has just been remarkably strong. We keep looking for evidence that that employers are pulling back on offering jobs or wage increases, whatever it might be. But in general, the labor market has remained very, very strong. So this is one measure. This is looking at non-farm payrolls. So how many new jobs are out there? And we saw it sort of like come off some highs and then start to stabilize. But then more recently, we saw numbers that suggested that there were even more jobs out there. Suffice to say that the labor market still remains very strong. What one area of the market I'll just mention is in the auto sector, where we've seen a lot of headlines about UAW going on strike. What's interesting is that this comes at a time when the smallest percentage of Americans that we've seen in many decades belong to a union. So even though unions are in the headlines an awful lot, it actually affects a very small percentage of US workers. That said, this is an important sector. And I thought that this helps highlight sort of like the reasons behind this strike, right? So the top blue line is real wages for folks who are employed in the auto sector. And you'll see there that wages, and again, this is adjusted for inflation, but wages peaked around 2003 and have been in steady decline since then. Meanwhile, if you look at total private sector, so all workers in all different industries, it's been steadily increasing since, essentially 1995. So, this is really what's compelling auto workers to go back to their employers and say, we deserve more. We used to make an awful lot more. Now, the challenge is that if you look outside the auto sector, most workers actually make less than auto workers. Now, there might be good reasons for that, but it highlights sort of one of the differences between the conversations that the auto industry is having and the rest of American workers. It's also why we don't think that this necessarily is a broader impact for the economy. It will be important for the auto companies, but isn't necessarily a reflection of the experience that other workers have. All right, so let's move on to stocks and bonds, because there's lots of interesting stuff to talk about. We always like to include some of these cartoons. So my long position was doing great until the tide went out. Warren Buffett has a famous quote about everybody looks good until the tide goes out and we find out who's not wearing any shorts. And so we saw a little bit of that in the third quarter after a very strong first half of the year. Then the third quarter of the year is where we started to lose some of that momentum. But if we look, there's a lot of talk about that strength in the equity markets being very driven by what we call the Big Seven or the Magnificent Seven. So some of the largest stocks in the index that just had extraordinary returns early in the year. And a lot of it was really, fueled by some real fundamental changes. And so you see here that the dotted line on top is just those large 7 names. And you'll see, a lot of AI related headlines during that time period, whether it was BARD or ChatGPT, NVIDIA earnings. So there were a lot of really genuine technological changes that happened during this period that helped to drive those names up. But it's a good reminder, too, if you didn't own those just a handful of names, your experience might have been very, very different. So the gold line there is the S&P 500, and you'll see still very great returns for the first half of or the first 3 quarters of the year, but not what you would have experienced if you had owned just NVIDIA. And then same with the Russell 2000 index, which is smaller cap names, just didn't have near the performance that we saw elsewhere. So for me, this is always a reminder of why we own a diversified portfolio, because if you were in the S&P 500, you still had a really great return. But if you had a couple of names and didn't own NVIDIA or Apple or any of these other ones, you would have really missed out. Now, there's been a lot of talk about the concentration of the market. And if we look at, let's say, just the top 10 names, so the largest 10 names in the S&P 500, and then calculate their size relative to the overall S&P 500. So typically, it's not uncommon for those 10 names or whatever the largest names in the S&P might be to take up a lot of market cap of the overall index. So we often see a pretty concentrated market. If you look at, so the chart on the left, if you look at the rightmost bar, that's telling us that the top 10%, the top 10 names in the S&P 500 have about 30% the market cap of the overall index. So that is a genuinely concentrated market, and it's among the most concentrated markets that we've ever seen. So when we talk about this being an unusual market driven by just a handful of names, this is a more extreme version of what we've seen in previous periods. Now, again, there is fundamental underpinning for what has driven a lot of this. And so on the right, you'll see profit margins for the S&P 100. So those are the largest names versus the S&P 600, which are some of the smaller names. And we look at those profit margins before COVID and then currently. And what you'll see is that not only did the largest names start with a higher profit margin, not surprising, right? They're more mature businesses, they're larger, they're more diversified, more efficiencies of scale. But so they started at a much higher profit margin, but they also grew their profit margins by more than the smaller companies. So, so if you think about it, some of these largest names have true, fundamental new technology that's driving their businesses, and they've been steadily improving their profit margins. So there's good reason why they're taking up more of the S&P 500 than what they have historically. So then if we look at then this by sector, this isn't, this concentration of the market is not consistent by sector. It's really in a couple of sectors. So the gold bars are looking at the sector within the S&P 500, and those are market cap weighted. So those returns are going to be very, very dominated by the largest stocks. The blue bars are if you took each of those sectors and said, say you have 50 names in the communication services sector, I'm going to equal weight them. So it gives a sense of kind of what's happening across the spectrum. Small companies matter just as much as the large companies. And what you see in communication services, information technology, consumer discretionary, the market cap weighted index had much, much higher returns than the equal weighted index. So those sectors were very dominated by just a couple of the largest names. Now, if you look at pretty much everything else, there's not a huge difference between the market cap weight and the equal weight. So you don't have this huge sort of difference in what's happening underneath the hood within those other sectors. One that I will point out is financials, where the equal weighted significantly underperformed the market cap weighted. And that is, if you think back to March, when we had, I'll call it a mini banking crisis, a number of regional banks went out of business. There was a lot of concern about smaller ones. So as you think, those smaller regional banks really kind of drag down the overall index. And that's why you're seeing that big difference between the two. All right. So then ultimately, the market will trade off of earnings. And this is another area where you saw recessionary-like conditions. So if we break this down, this is looking at earnings for all the companies in the S&P 500. They all get put together. The blue bars are showing actual earnings. The gold bars are what the market is expecting. So what analysts are saying that companies in the S&P 500 are going to earn. And you'll see there from 2022 to 23, it's about flat. And then looking to next year, 2024, the market's expecting about a 12% increase in earnings. So that's a pretty healthy level. If you take those numbers and look at it by quarter, what you'll find is that the peak to trough earnings by quarter was down about 10%. Which is typically what you'll see in a mild recession. You will see peak to trough earnings decline by about 10%. So this is another area where if you look under the hood a little bit, we've already experienced recessionary-like conditions, at least in one part of the economy. And going forward, this kind of 12% earnings growth is about in line with what you would historically see, a little high. But close to kind of within range of historical average in terms of year-over-year earnings growth. So then the question becomes, how much do you pay for that, right? So we have a good sense of what companies are going to be earning. What's the PE or the valuation that you put on those expected earnings? So this looks back to 2000 and compares the current price of the S&P 500 to what the market expects those companies will earn over the next 12 months. That red line shows you the average, so it's about 16.5. And right now we're running a little bit higher than that. So typically valuation is not a very helpful timing indicator. So even when valuations are really high or really low, that doesn't tell you where the market's going to go in the near term. So unless it's really extreme, it doesn't give us a lot of input, but it'll generally give us an idea of what your returns can be over the next couple of years, because the market tends to react to this kind of slowly. So right now, the market's looking a little expensive relative to history, but not on an extreme level. And again, if we have a pickup in earnings going forward, then the market will sort of earn its way through those higher valuations. So it's feeling like fairly comfortable where we are right here. If we dial in a little bit more closely and sort of think about where the market is trading right now, we start to see some interesting things. So one way that we can help divine where the market is going in the near term is by looking at market technicals. So this can be, there are a whole range of different tools that you can use to look at this. One might be asking sentiment. So if various types of investors are saying that they're very bearish on the market, so they're really nervous that stocks are going to go down, that's often a good indication that stocks are going to go up. One other, indicator that we can use for this is looking at where stocks are compared to where they've been. So one way of measuring this is looking at a stock relative to its average price for the last 50 days. And then we look at all the different stocks in the S&P 500 and say, okay, how many, what percentage of those stocks are trading below their own average of the last 50 days. And so you can see in those red circles are periods over the last couple of years where very few stocks were trading above their average levels over the last 50 days. Often, though, at least in those instances, those prove to be really good buying opportunities for the market. And you'll see more recently where about 15% of stocks are above their 50-day moving average. That's a positive sign for us that stocks are kind of oversold and can be a good opportunity to buy into the market. I'll also add, we have some calendar effects where September is typically the weakest month of the year. October typically has the most market bottoms. So if you think about some big events in the market, they tend to happen in October. But then, and I joke that I always seem to have a blog that I write that talks about the seasonality and then has some really bad Halloween puns in it, like October is spooky. But then the nice thing is we go right from kind of that spooky market into what we often call the Santa Claus rally, where seasonality tends to really help stocks towards the end of the year. Now, again, I don't like to trade off of these things exclusively, but they do try to help us give a sense of where the momentum will be headed for stocks and other types of asset classes. So we feel like there's a fair amount of bad news in the market, which is good for investors, and that can help sort of lift assets going forward. So let's take a minute and look at the bond market, because here's where it's been a very interesting time over the last couple of years. We talked a little bit about the Fed rate tightening cycle. Interest rates are up, getting a lot more expensive for borrowers. I mentioned how mortgage holders are largely inoculated from higher interest rates because they have a fixed rate mortgage. Well, the same is true on the corporate side, where many, many companies have taken advantage of low interest rates over the last 10 plus years to be able to extend out their loans, to shift from floating rate loans to fixed rate loans. So as interest rates have ticked up over the last couple of years, many companies are not feeling it because they don't have any loans coming due, or it's fairly minimal. Now that will start to change over the next couple of years. So this chart is looking at the number of dollars in loans that start to come due over the next few years. And you'll see investment grade. So those are higher quality companies that are borrowing. We start to really ramp that up over the next couple of years. So these higher interest rates will start to work their way into American companies over the next couple of years. And with that, we've started to see a little bit of stress on these companies. So if we look on the left, these are a number of bankruptcy filings. You can see the blue bar is year to date. So we wanted to be able to compare the experience this year with what you have seen for that first part of the year in other years. So you can see the blue bar alone is the highest that we've seen since 2010. And then, we'll find out over the next couple of months, but I would suspect that based on that trajectory, that we will close out 2023 with the highest level of bankruptcy filings in, 13 years. Now, 2010 was not a horrible, horrible year. That wasn't like 2008 might have been, but it is something that bears watching, particularly if you look at the right chart. So this is looking at high yield spreads. So how much does a high yield or how much does like a lower quality company have to pay to borrow money relative to, say, a treasury market? So it gives us a sense about how much investors are being paid to take the risk of lending to a lower quality company. And what you'll see there is that spreads are pretty low. So the market is not requiring a lot of extra cushion when it comes to these. So what that means is that there's not a lot of risk built in. And so this is one area where we're seeing bankruptcy filings tick up. We see more companies are going to have to refinance their loans. And we're not being paid a lot of extra in the high yield market, at least, to be able to lend to these companies. So it's one area where we would be cautious. Other areas of the fixed income market we're feeling much more comfortable with because we already have a lot of that bad news in, right? The Fed has done its interest rate tightening. Rates have gone up a lot. And so we see a lot more opportunities on that side. So with that, let me close out with one of my favorite charts. You may have seen this before, and then I'll be happy to take some questions. So this data was put together by Professor Jeremy Siegel, who's been on, a number of events with us. He's a fascinating guy. He put together this data back in the 1980s before Excel was really a thing. So he was able to get asset class data going back to 1800. So we now have over 200 years worth of this data. And so what was really unique about this was not just the fact that we had 200 years worth of data, but then he also had inflation data for each of those. So he was able to put those two things together and get to what we would call a real return. So, if you were invested in stocks in 1860 and you owned it for 20 years, what would have been your experience taking into account the effect of inflation? So how much more would you have been able to buy after owning those assets for 20 years, even after inflation kind of took its bite? And so a couple of things that I think are very interesting. One is on gold. You'll see that towards the bottom. And you'll see there are periods where gold really has very, very strong performance. But then if you look back over 200 years, gold has not been a great way of growing wealth. It's been very helpful in times of trouble, but those times tend to be relatively short-lived. And so I get questions about gold a lot, and I use this as an example of where it's not a great place to be for a long period of time. Now, contrast that with stocks all the way up at the top. And what you'll see is that performance moves around a fair amount in short periods of time. But that red line just shows you the trend line, right? Up and to the right. And it's been remarkably consistent. If you look over, more than a couple of year period where stocks after inflation have returned 6.7%. And in fact, when Professor Siegel and his team put these numbers together in the 1980s, the annualized real return in the 1980s for that whole period was 6.7%. So we now have 40 more years worth of data, and that long-term return is the same. So as you look for ways to grow wealth over time, stocks have by far the best track record of being able to do that. Now you'll see bonds, right, up and to the right also, really good, attractive ways of growing wealth in a slower, more stable way. So having those two together is such a great combination to be able to reliably build your wealth over time. And I love this quote from Professor Siegel: stocks are the most volatile asset class in the short run, but the most stable actually in the long run. So if you have that longer term time horizon, that's a great place to be. So let me pause there. I think I've talked everybody's ears off. And let me take a couple of questions. So just a reminder, if you have any questions, please feel free. There is a button on the bottom that says Q&A. Just click on that and type them in. So I see we have a couple here already. So what's your view of dollar strength going forward and possible effects for the economy? So it's been incredible looking at this. We were looking at this recently. The dollar relative to most other currencies in the world has essentially been going up since the 1970s. We've had periods within that when the dollar lost some of its strength, but it's been, a multi-decade push. And what that means is that it's been a huge tailwind for US assets versus non-US assets. So if you own, if you live in the US and you make your money in the US, it's been that dollar strength has hurt the relative return of, say, investments that are priced in euros. But that's also come with a lot of challenges as well. And so there's a lot of concern that, the strength of the US dollar is going to be challenged. And I'm not here to make an argument that the dollar is going to start to lose value. But I do think that over time, that tailwind for the US dollar will start to minimize, and it won't be the same sort of benefit to US assets that we've had. And that's part of the reason why we feel strongly that you need to have some exposure to non-US assets in order to have that diversification. Now, as you think about a strengthening US dollar, that also means that Americans are able to buy non-US goods for much cheaper than what used to be the case. If the dollar starts to stabilize or decline, foreign goods become more expensive, right? So that tends to be the most immediate impact on dollar strength or weaknesses. Then, of course, if the dollar declines in value, non-US goods become more expensive. That also drives up inflation. So it becomes this kind of like tricky web of interdependencies, where I think more than anything, what we want to be able to, as like an economist or how the Fed thinks about it, is more you want stability rather than a big change one way or the other. So let me just pull up these other questions. What are your thoughts on recent suggestions that the Fed may be able to avoid raising interest rates due to the continued rise in yields? So that, again, back to the Fed and the impacts. So let me make this clarification because it's not always obvious. The Federal Reserve controls what's called the Fed funds rate, right? So that is an overnight rate. It's one day. But if you think about the yield curve, there are bonds all along different maturities that have various yields. So if you think about a 2-year Treasury bond, a 10-year Treasury bond, those all move independently. So the Fed might be raising interest rates here, but these long-term interest rates are going to kind of move where they will. Now, again, they're connected, but the Fed doesn't control 10-year interest rates. They influence longer-term interest rates. That said, they're an important input into how the economy is sort of absorbing things, and they do some of the work for the Fed. So to be a little bit more specific, the Fed has been increasing that overnight rate, and then more recently, 10-year yields have been going up quite significantly. Actually, I should go like this because short-term interest rates are higher. Oh, thank you, Ryan. That's super helpful. So let's look at, okay, now, so the blue line is all the way on the top, and that is yields as of the end of September. So if you look at those very short-term interest rates, they've increased significantly. That's all been the Fed. But if you look over at the 10-year yields, that has also increased. And now that's not directly by the Fed, but it's still influenced how the economy is feeling. And so there's an argument to be made, which I think is a good one, that higher long-term interest rates that we've seen lately is essentially doing the work for the Fed. That maybe the Fed doesn't have to increase short-term interest rates so much if long-term interest rates are increasing. So that's a very long-winded answer of saying yes. The increase in long-term interest rates is allowing the Fed to not be as aggressive on short-term interest rates. So we talk often about this idea of financial conditions tightening or loosening. As interest rates go up, whether it's on the short end because of the Fed or on the long end just because of economic conditions, as interest rates go up, that tightens financial conditions. It's more expensive to borrow, so people are less likely to run up their credit cards. Companies are less likely to borrow. And so we've seen a lot of this tightening of financial conditions as interest rates have gone up. Now, if interest rates go up a lot more, will the Fed start cutting rates? I'm not sure we're there yet, but it does sort of allow the Fed to take a bit of a pause and say, okay, we're just going to wait for a minute and see how these interest rates sort of filter in through the economy. All right. Gold. Okay, so we talked about this a little bit. Gold is up nearly 20% over the past year. Given the geopolitical uncertainty coupled with lingering inflation, do you see further upside in gold and or other commodities? So gold tends to be a lot harder, at least in my mind, a lot harder to predict than other types of commodities. So if you think about the role that gold plays in the economy, other than making pretty jewelry, it doesn't serve an economic purpose, right? There are no components that are made with gold. It doesn't go into building buildings. And so what drives gold prices is sentiment. And I always think about my father-in-law, who was in East Germany, escaped there shortly after the war and had a couple gold coins in his pocket. And when each of my kids was born, he bought each of them a gold coin, kind of showed it to us, and then put it right in his safe. And for him, like, given what he had experienced, like, that was a store of value that helped him sleep easily at night. And that is the purpose that gold serves. But it can be very hard to predict that, right? And the questioner asked rightly, tied it to geopolitical uncertainty. So when people are really sort of worried about the overall environment, that might be a place that they go. But it's not driven by things like economic growth or competitive advantages. And because of that, it's really difficult to predict. Now, I think other types of commodities like oil, that tends to be a commodity that we focus on a lot, is much more driven by economic demand. Now, there is still a very geopolitical component to it because that can impact supply, but demand for oil tends to be very much dependent on overall economic demand. So there, we've seen oil that has gone up fairly significantly over the last couple of months. And we think, given what's happening in the world, there's a pretty good underpinning to those prices. We're seeing oil producers, at least in the US, be very disciplined about how much additional production that they're bringing online. So we're not seeing a huge sort of influx in supply from these marginal producers. And then we also have, still war in Ukraine. We have war in the Middle East. These are areas where there's a lot of oil production, and it quickly becomes a very political kind of game. And then the global economy remains remarkably resilient. So overall, we think that there are some pretty good underpinnings to oil, but gold is going to be much harder to predict. All right, last question. What are you watching for going into earnings season? So, we talked a little bit about this, and we're just getting into earnings season right now. Broadly, what we want to be able to see is broad-based momentum in companies starting to build back their earnings growth. We had seen, and you can track this in data, which is pretty fun, and I think we'll have a piece on this next week. But you can track, for instance, like the number of companies that are beating analyst estimates versus missing. So what we want to be able to see is continued increase in the number of companies that are able to beat expectations. So that's one kind of like macro trend that we'll look for. Another one is more in terms of the individual company commentary. And one that I'm watching closely is commentary on the consumer. I mentioned earlier that the consumer has remained remarkably strong. The labor market is very strong. But is there evidence that individual consumers are starting to feel a bit of the pinch of those higher interest rates on credit cards? And similarly, student loans are coming back online. So where do we see that kind of pressure coming in? And so types of things that companies might talk about are trading down. So moving from premium brands to, let's say, house brands, or smaller ticket. And so often we can get some really good feedback from CEOs as they kind of like look at their own consumer base. So great. Well, let me pause there. Thank you so much for joining me. And thank you for the questions. I always love to hear what's top of mind for everyone. We do have this piece available. So if you're interested, we're happy to share the slides. And as always, invest well and live richly. Thanks so much.